Hi, I'm Jeff Laurie and I'm with the co-founders here at Emerald Power. Many of our clients are asking us, how do we report our carbon footprint? We have suppliers asking us, we have investors asking us, we have stakeholders requesting it. Many businesses simply do not know how to calculate their carbon footprint. And it's predominantly down to the fact that they have never actually done any type of carbon footprinting assessment before in the past. So today we're going to give you a quick breakdown in terms of what it takes in order to calculate your carbon footprint for your company. Essentially, what we're going to look at is a few simple things. What is carbon accounting and what does it mean? What are the three different scopes within carbon accounting? How do you define the boundaries that are applicable to your business and what data points do you need to have access to in order to formulate your carbon footprint? What are the best practices for calculating your carbon footprint and how do you actually go about reporting it? So the first starting point is what exactly is carbon accounting? Carbon accounting is essentially the accounting of greenhouse gas emissions that stem from your business. It's the process of measuring, tracking, and reporting the amount of emissions that are emitted from your business or organization as to do with any type of activity or transactions that your business has made over a period of time. So carbon accounting is essentially divided up into three different scopes. We have scope one, scope two, and scope three. Within scope one, we have direct emissions. These are essentially emissions that stem directly from your business, from fuel you consume on site. So, a really good example of this would essentially be if you have a diesel generator on site that consumes diesel in order to output heat or power something, that would be classified as a scope one emission. Another example would be if your company owns any vehicles. So, for example, if you have a truck or a van or a HGV that your company owns directly and burns petrol or diesel to get from one location to the other and transport your goods, then that's also classified as a scope 1 emission. Your scope 2 is slightly different. It's essentially any type of energy that you purchase in order to consume. So in this case, electricity and also gas would fall under scope 2. It's essentially energy that you're bringing in from an outsourced location and then essentially using it in order to power or fuel your operations. And then finally, we also have scope 3, which tends to get a little bit more complicated for many businesses, predominantly because there's so many different variables to it, and it's all to do with the supply chain and value chain within your business. As you can see here, it's important as you as a business to be able to define what entries are relevant to you and your business. So here, as you can see, we have scope one, scope two, and scope three divided up into a number of different categories. So obviously scope one, we have direct emissions. Scope two, we also have indirect emissions. And scope three are indirect emissions, both upstream and downstream emissions. I think this is a really good chart to take into account because it will give you an overview of what activities are actually going to be relevant to your business. If you're simply a small service-based business like a marketing agency or a professional services firm, you might not even have a scope one. The only ones that might be even relevant to you is a scope two if you have an office. But if you're a fully remote workforce, you mightn't even have a scope two as well. You might just have a scope three. But I can tell you for a fact, the majority of the clients that we work with, 90% of them, their biggest hotspots are their scope three. And it's also the most difficult to measure. So when it comes to scope three, it's really important to actually take into account all of these different categories, look at them in detail and determine which ones are relevant for you. This is what they call a materiality assessment. It's basically looking at what categories are material to your business and how are we going to measure them against our carbon footprint. So now that you've decided what categories are material to your business, it's time to work out the calculations with them. So what we can do in this case is the best practice for carbon accounting for scope one and two is to primarily use activity-based data. What this means is that we're using hard metrics here in order to formulate our carbon footprint. Let's take electricity under scope two, for example. If you purchase electricity from a supplier, there's a very high probability you will get a bill at the end of every month or every second month stating how many kilowatts per hour you've consumed and also the cost associated with that consumption as well. What we can do is we can take those kilowatt hour numbers and actually plug them into a formula against the relevant emission factor and actually use that to calculate our carbon footprint. So using a relevant emission factor that's relevant to our country and our grid connection, we can then take that and use it against it to formulate a carbon footprint against our electricity usage. So as you can see here, We're taking 10,000 kilowatts per hour in the example here, and then we're also using an emission factor of 632 in order to formulate our carbon footprint. This number is completely random. Every business and every country will carry in a different emission factor depending on their grid connection and also depending on their supplier. There's various different emission factors, and there's also different formulas based on location-based methods and market-based methods, which we'll touch on in another video. In order for you to actually calculate your scope 3, it's probably best advised to use spend-based data. Due to the limitations around data within scope 3 in your supply chain, especially if you're a small to medium-sized business, you might not be able to have access to large quantities of data or even have the resources to pull that data together. So we would always recommend to our clients to use spend-based data. So simply looking at your transactions that you've made over a period of time, you can use the monetary value within those transactions in order to formulate your carbon footprint. There are various different emission factors on various different databases that allow you to use financial-based data and calculate it against various different carbon footprints depending on the type of transaction that you made. So we would always encourage our clients to download transactions from their financial systems, their banking systems, procurement systems, or even just simply any kind of accounting system that they have internally where they can download a CSV file. That's simply the best way in order for you to calculate your carbon footprint. So as you can see here, if you spend 10,000 on business travel over a period of a month, you can essentially use an emission factor against that value and actually work out what the carbon footprint was associated with business travel for that. We do always encourage users to go a bit further. If, for example, you know exactly if you purchase flights and you know exactly the starting location and the end location from those two flights, we'd always encourage you to try work out the kilometers traveled to increase that level of accuracy. So what that will do is rather than using spend-based data, you'll bring it up to activity-based data because you're working off hard metrics and you're increasing the accuracy behind it. If you are interested in using a solution in order to streamline carbon reporting, you can, of course, use Excel sheets. It's very time consuming. You have to source all the emission factors yourself, and it can also be quite error prone, and you have to keep it updated. There is the option, of course, to hire a third-party consultant, but they can be quite expensive, and you're typically paying for a one-off PDF document. So what we do here at Emerald Power is we essentially provide small to medium-sized businesses with a carbon reporting solution. It's essentially where they can go within a few quick steps, upload their data, and it spits out their carbon footprint. We leverage financial-based data, activity-based data, and supplier-based data in order to formulate the most accurate and robust carbon footprint possible. We also leverage a database of over 70,000 emission factors to ensure that our clients get the most accurate results based off their readings. It provides a complete audit paper trail for verification so that you know that you're in good hands when it comes to actually reporting against it. If you are interested in learning a little bit more about this and ultimately how you can streamline your footprint, your company's carbon footprint, shoot me over a message and I'll be more than happy to help. You can message me at info@emeraldpower.ie or feel free to visit our website at www.emeraldpower.io where you can check out our pricing, take a look around our product, and if you like it, you can book a demo. I'll shoot all the links below in the description. If you have any questions, we'll be more than happy to help.